Bitcoin, which has just dropped below $17,000 per coin. There is news going on here. This is the story of the day, especially if you're in crypto. FTX, the big exchange, has filed for Chapter 11 bankruptcy. The chief executive, Sam Bankman-Fried, has resigned. Susan, running into the studio with last-minute news. What do we got?
Yeah, so I was just sifting through a lot of the commentary this morning on the stunning FTX collapse. So the latest being Larry Summers, the former Treasury Secretary, calling it a possible Enron in his view. Ooh. You have other commentators saying that they feel they were duped because Sam Bankman-Fried, FTX, was one of the largest crypto exchanges in the world, and he was effectively the poster child for this new asset class. Now, as for others involved here, the contagion effect, this voluntary bankruptcy filing is 130 subsidiaries, and that does include FTX International and, yes, the U.S. trading arm as well. Only LedgerX, digital markets, and Australia are excluded from this bankruptcy filing, but there is talk about contagion effect because FTX at its peak was worth $32 billion and Bankman-Fried himself was worth close to $20 billion. And now they need to pay back 100,000 creditors. If you look through the balance sheets, liabilities and assets are pretty much the same, $10 to $50 billion, so there's no spare cash there to pay back those that are owed. But you also have to remember that SBF, Sam Bankman-Fried, was saving a lot of these crypto companies that went under this year after that Three Arrows hedge fund blow up and the Luna stablecoin blow up, and that includes BlockFi. If we can bring up that quote once again, BlockFi saying last night that they themselves were dismayed and disappointed by the news regarding FTX and Alameda, and they only found out on Twitter like everybody else. So as a result, they have now stopped withdrawals and limiting platform activity. And there's a lot of questions about that. Who's been involved here? Also, you have a lot of celebrities that are paid endorsers and some with actual equity in the company itself. If we can bring up this celebrity board for you, of course, Tom Brady, Giselle. Yep. They were two of the marquee endorsers, and they had warrants actually in FTX.
So over the past 18 months, it's really been a bloodbath in crypto. We've seen CFIs, exchanges, exchanges, hedge funds, all go bankrupt. Ronald, do you want to call out anything on the Terra Luna collapse?
Oh yeah, Terra Luna is just not a centralized platform, but it was a UST collapse, which was supposed to be an algorithmic stable coin on the Terra chain. So yeah, it extends beyond just centralized platforms. Protocols themselves that are failing.
The question is that do people think that control frameworks or better control frameworks could have saved these firms from collapse?
I think, Peter, if I may, it's worth separating things like Terra and protocols that fail from centralized players failing. I think those are two very separate things. And to answer your question as to whether or not a control framework would have helped, I think we should be focusing on the CFI, like centralized, trusted third parties side of things rather than on the protocols. I think, well, I don't know everybody on this call well enough, but I don't think we've got the expertise to solve risks involved in the protocols themselves.
There are two separate questions. One is, what's a regulator's responsibility? Normally, you have regulated activities, and there's a set framework, and the regulator has oversight, or it's geographic, and countries have set controls, or why are some of these in offshore jurisdictions, small offshore jurisdictions, have they got resources to actually manage those risks at sort of country level? So there's that, but then when you look at FTX, you go, well, that was I don't know where FTX was based. Was it actually based in the US? I think it was offshore as well.
The Bahamas.
It was Bahamas. Okay, so I think there's that level, which is the elephant in the room. And from a purely financial point of view, if you're trying to make money and you don't want that oversight, you will base it, or there's tax breaks, or there's low tax jurisdictions.
So I guess what you're saying is that you're not just looking at internal control frameworks. You're looking at the influence over internal control frameworks like regulatory bodies.
Yeah, I mean, I think that's the elephant in the room. And when you, let's say you're a bank and you've decided that you're going to set up crypto, there are still control frameworks in place, which would still be best practice, and you still need to have in place, because otherwise that could have a knock-on effect to your brand.
I just wanted to explore some of the common themes for here. Mike, you made a really good point about separating out the CFIs from the actual technical specifications for the protocol.
Yeah, like when you mentioned Terra Luna, I was just basically reacting to that inclusion in this. I don't think that a control framework should take that into account. I mean, that's exposure to different protocols in the DeFi space. If we get onto that level, that's to do with, do your own research, and, there's a real risk return scale or trade-off when you're playing in DeFi. But I don't think we're equipped to really deal with that when designing this control framework. But in terms of how we build a control framework to prevent like embezzlement and misappropriation of client funds like FTX, that's something we can definitely deal with the expertise in this group, I think.
Essentially, there seems to be a lack of authenticity or integrity from some of the players in the market. The big one, Paul, that you've called out is operating in jurisdictions which lacks, rigorous regulatory oversight. So choosing jurisdictions where it's easier to do business, there's less of an investment required in controls. Transparency and operational governance, financials and ownership. I mean, the reason why we saw FTX basically collapse was because they did release some financial information which turned out to be accurate, that had an adverse effect on their firm because it showed that a lot of their assets were their own token. We have an existing player in the market, significant player in the market, where there is a lack of transparency into their operations, including ownership and governance, and even financials as well. Expansive monetary policy. Look, this didn't actually cause these firms to fail, but I think it encouraged investors, like myself, to go searching for yield. So investors who went searching for yield and didn't do their due diligence, and perhaps had a bit of greed, a bit of FOMO, a bit of panic and urgency, were more likely to encounter losses. And the video mentioned celebrities endorsing crypto. Like, it reminds me of the Fire Festival, that Netflix series, which looked at somebody organizing a party on a deserted island and celebrities posting an orange tile on the Instagram feed without really knowing the details behind the organization of the party itself. Lack of segregation of duties and challenge, both inside and out. So there are stories going around of the Celsius CEO going down to the trading floor and making trading decisions and overriding risk management and his traders. And then there's also evidence from the bankruptcy or the FTX hearings that Sam Bankman-Fried signed off on his own loans from the company. So up to $1 billion was borrowed with his signature, issuing funds to himself. This one here, I think, lack of understanding of material risks, or they knew their risks, but they didn't establish proper limits in line with board-approved risk appetite. So what I mean here is that in the case of Celsius, they wanted to pay a yield on Ether, but then Ether was locked up due to the upcoming fork. So instead of not taking on Ether and not providing a return, they had to engage in DeFi and a derivative of Ether to provide that return. So I guess I asked the question, did they actually understand the risks that they're exposing themselves to and their clients to as well? And then in the case of FTX, I mean, the CEO didn't mention, or CEO of Alameda, she mentioned on a video that they didn't really go for things like stop loss limits. Grew too quickly. So Celsius, there was talk of traders having to watch YouTube videos to learn how to trade DeFi because they were getting into DeFi quite fast. Any other common themes you think from the collapses which we're focusing on?
I mean, I think you've covered it well, Peter, but I do think that it's worth mentioning that all of these themes are around us trusting a third party, and the original goal set out in the white paper of Bitcoin was that we shouldn't need to trust third parties. And I know I harp on about this a lot, but it's almost like we're trying to recreate trusted third parties in an ecosystem that is designed to avoid trusted third parties. So crypto digital assets is about self-custody. You shouldn't have to trust anybody for more than a short period of time. In fact, with any third party in the digital asset space, I prefer strongly to interact with those that encourage self-custody and make withdrawal extremely easy into your own wallet rather than making it difficult, and that don't offer over-the-top high yields to try and encourage me to leave funds with them. Those are all complete warning signs to me that they're not to be trusted. I know it doesn't help building out a control framework, but it's something that is extremely important to keep in mind, I think.
Well, I think it kind of does in a way. So if you can't get down the route of self-custody, be aware of what the risks you're exposing yourself to by having that counterparty risk, and how can you manage that counterparty risk.
Yeah, totally agree. I've got a list of things that I look at when dealing with third parties, and you mentioned quite a few of them there. And I think, Paul, you mentioned one as well, actually. But like where they are based, the location of the third party is one of them, and easy withdrawal. I only deal with counterparties that make it extremely easy to withdraw crypto Bitcoin from their platform, like Kraken is live on the Lightning Network to make it extremely easy to pull Bitcoin off at really low fees. That makes me feel like they're a more trusted third party than an exchange that isn't on the Lightning Network, just as an example. This is not a plug for Kraken. Then no native token. I think you mentioned that as well, Peter. Any exchange that issues their own token and tries to increase their revenue and encouraging you to hold their native token by giving you discounts on their platform when you hold it, that's another way of encouraging you to leave funds on their platform. So that for me is an alarm bell as well. Those exchanges that focus on less coins rather than trying to offer every single crypto asset on the 20,000 list of coins available. Less coins. It's like going to a restaurant that offers 5 main courses. I've got far more faith in that restaurant making me a good meal than a restaurant that's got over 100 dishes on their menu. Then proof of reserves, I think you mentioned that as well.
That's actually, sorry, I come in quite late. That's true, when I do the same thing. When a restaurant has too many dishes, I think it can't be good. Paul, you're a big foodie. Do you do the same thing?
Yeah, of course. It's just logical, isn't it? Something's going to be frozen, or
exactly. Or 20% of the meals is the same base. They just add a different sauce on. Like it's the same. Exactly. So less is more, right? Like you want to do less things and you do them well. And I think that is the same in the digital asset space. I think that every coin that is on a new blockchain that you offer on an exchange increases the technical complexity of that exchange, because you've got to be plugged into more blockchains. So that I think that's just logical to me, just as Paul said. Then proof of reserves. I know that there's been a bit of press around proof of reserves, and they're not worth the paper that they're written on. But I believe we will get to a place where there is a way of proving out reserves at exchanges or trusted third parties that is reliable. We're just not quite there yet. And once again, I believe we're not there because we're trying to design that proof of reserves based on the auditing model that worked in TradFI space, and that's not how we should be thinking about proving crypto assets. I think it's a different beast, and we should be thinking a little bit more along the don't trust, verify route in the way we prove the reserves in digital asset space. And then the other one, Peter, you mentioned, is high yields. If an exchange is offering me a higher yield than I can get if I stake coins directly, then you're the yield. So just remember that. Like, there's no way an exchange can earn more than somebody directly staking coins. It's not like you get bulk discounts when buying wine if you buy more than 1,000 bottles. It's not like that in the crypto space. There's this certain yield you can get from staking, and if an exchange is offering a higher yield, then there's a problem. That's just a way of getting you to leave your coins on their exchange. So those for me are the list of things you should be looking at when choosing an exchange to trust, and you use that exchange for a shorter period of time as you need to. You transfer money, you buy what you want, and then you extract your funds. I've made analogies in the past to comparing exchanges to public toilets, and I'll do it again here. You only go into a public toilet when you need to, but you don't spend any more time in that public toilet than you need to, right? You have your own wallet, you withdraw your funds. That's how the world of digital assets should work.
Side of the fact that you've actually got to make sure that your IT is strong enough, and that's an industry on its own. And now we're just talking about risks, and we're talking about costs. Another way of doing it, of course, would be that if you couldn't hold them in your own wallet, or the risks of doing that, then obviously, it seems logical that you would diversify. You might hold your assets across 10 exchanges, and it would.
So that chimes in nicely with, can we learn from the, sometimes disasters, sometimes significant events which have occurred, in the TradFI space over the past 30 years. So probably the oldest event that I'm aware of, following the 1987 stock market crash was Nick Leeson and Toshi Hideguchi and their rogue trading losses. Toshi Hide caused Daiwa to have to leave Manhattan, and obviously we know what happened with Nick Leeson and Barings Bank. But the banks have had to go through liquidity squeezes during the GFC, capital shortfalls, counterparty defaults, systemic risk, outdated accounting rules. So they've been through a lot, and I really want to raise the question, can we actually learn what they've been through? And the reason for that is that the Bank for International Settlements, the accounting standards, the best practice in terms of control frameworks have all really been built on the significant events which have occurred in the TradFi space. Just to remind ourselves, control frameworks, what are they? Well, essentially control frameworks are meant to provide some assurance regarding the pursuit of a firm's objectives. So an organization is going to have financial and operational targets. How much money do you want to make? The return on capital. They're going to want to issue reporting internally and externally, which is free from material error. And then they're going to want to comply with all the rules and the regulations in each of the jurisdictions within which they operate. And I think we're old enough to realize that the pursuit of any objective is not risk-free. I think even running at my age is not a risk-free objective or activity. So risks come from outside the organization, like a car potentially running you down, or a rogue chihuahua, or from inside the organization, say my heart or my left knee, which had some cartilage removed, could cause me some havoc. So the purpose of a control framework is to know what you want to achieve, identify the risks to achieving that, and then design internal controls to mitigate those risks down to an acceptable level. And then making sure that those controls are tested on an ongoing basis to verify that those controls are effective. So, I might go and wear a knee guard and get a scan or go to physio to make sure that knee guard is working correctly. So Paul made the really good point that controls can be both preventative and detective. Okay, so preventative and detective. And when we do test the effectiveness of the control, it's both from a design perspective. So have we designed the controls correctly? And then are they being performed consistently?
What's missing here is the fact that you have stakeholders. So the stakeholders, the obvious stakeholders are, you might have shareholders, but you might have, if you're a bank, the wider community. So when the bank started failing, they weren't allowed to fail because they were integral part of the financial system, and all of the retail accounts and the man in the street, my high street and stuff like that, they would have all been severely impacted if the banks had failed. But you've got these stakeholders and the state. So you've got objectives, which are financial targets, reporting and compliance. But the bigger question that regulators are trying to come out with is who are your stakeholders and how can they be negatively impacted?
This is an example of where banks have gotten to from an evolution process, I suppose, of having mistakes, encountering issues like the GFC, rogue trading, liquidity crunches, COVID. And essentially, banks know that they face a number of risks across their organization. They know that they have financial risk and non-financial risk. And I think most of us will recognize the financial risks. On the non-financial risk side, it's a bit of a longer list, which we may not think of as financial controllers, CFOs, product controllers, or Paul, as an auditor, you're obviously going to think about it. But essentially, the organization knows that these are the risks which it faces, which means that these are the risks which it needs to control. And this picture, I guess, illustrates that they really see the risk appetite and culture for their organization coming from the board level down. And those risks and the performance of the controls around those risks are really communicated back up to the board through these subcommittees there.
Actually make internal control report through to a separate board, a board audit and risk committee that has a lot more non-executive directors and a lot more independence. So we try to make it sort of within management, but outside of management. But of course, the elephant in the room is that the internal controls are part of management. And then what you've got is you've also got external audit. And I come from an external audit background as well. And of course, you're supposed to be independent, but the elephant in the room, as we've seen before, is the fact that they're employed by management. There used to be additional audit services, such as consultancy, and those used to impact on independence. And then finally, external auditors, they're not their get out of jail, but they talk about materiality, and they specifically talk about the fact that they're not there to actually identify fraud.
The question I had at this point is that looking at this, I mean, it's quite a behemoth. It's quite a large and complex structure. There's lots of resources devoted to risk management and reporting. Do we think that something like this is needed in crypto?
Is it needed for crypto? There's lots of different players in the crypto ecosystem. So are you asking,
probably trading and lending firms, crypto trading firms.
So like if we were creating a new Celsius, is that what we're saying?
Celsius or Alameda, I suppose.
Mm-hmm. So, okay. Yeah, Alameda, so a hedge fund or something like that. Okay, because yeah, I'll park aside the fact that I don't believe we should have a Celsius in the market, but let's just ignore that. So if you were recreating a firm that traded crypto, that offered crypto products and had customers and had custody, would you need a framework? You absolutely would, like 100%. And you'd need all the traditional departments like credit risk, market risk, and but you'd have to think a little bit more outside the box in terms of how you set those things up so as not to let significant risks fall through the cracks. It's quite complicated to monitor the flow of all your crypto assets through different wallets and understand public private key encryption and things like that. So you'd have to have the right expertise in those departments understanding those things. But that wouldn't change, for me, that wouldn't change the fact that you need those departments and those risk functions in place. So for me, it's ensuring that you have the right expertise in those departments and the expertise in the crypto space from an audit and internal controls, external as well as internal audits perspective. I think those skills are still lacking and people don't yet fully understand how it all works. And the accounting regulations, and other regulations have not kept pace with the pace of change in innovation in the crypto space. And therefore it's kind of like, I love a good comparison, but like it's kind of like drug cheats in athletics, right? There's always more incentive for the athletes to come up with new drugs that the tests don't detect. And crypto is going to innovate a lot quicker than the regulation can keep up. That's just the nature of the beast.
Thanks, Mike. Thanks for that. 3 lines of defense. So we have line 1, and these are functions, including business and support functions, who own risks. So if you're in finance, you own the risk of materially misreporting the financial statements which go out to the external world. So you have to design controls to mitigate the risks. So to reduce the likelihood that you're going to issue financial statements which are misreported. In line 2, we have, this is part of the functions which report up into the chief risk officer. And these guys are responsible for designing, or operational risk is, designing the overall control framework for the organization. And then we also have other functions, credit risk and market risk, which oversee and implement limits and monitor usage of those limits against the, say the price of Bitcoin or the, the counterparties, Ledin, Kraken, Binance, etc. And then the third line of defense is audit, and audit essentially meant to be confirming to the board, or not confirming, that the risk framework which has been set up for the organization has been designed effectively and is performing well. Okay, so what's crypto used for? Look, I say this, JP Morgan executes their first DeFi trade on a public blockchain. This happened a few months ago in Singapore. And essentially they use tokenized deposits. I think it was Singapore dollars and Japanese yen for about 100,000 Sing dollars. And they were doing this to achieve faster and cheaper settlements. We also had news in the last couple of days of the NAB, so one of the bigger banks in Australia. They are or have set up their own stablecoin. And again, they want to achieve faster and cheaper settlement. Trading and gambling obviously is probably gets more headlines for crypto than like its other use case scenarios which benefit society. Borrowing and lending occurs in crypto, and we can use crypto tokens and coins to do that. One stage before Terra collapsed, so the UST stablecoin, you're able to earn yields of 20%, given interest rates were almost zero, just remarkable. And then finally, we have NFTs, so transferring the rights to physical or digital assets. And we also have gaming as well, so using cryptocurrencies to play to earn. And I found out only yesterday, reading an article, Martin, about in Korea, they try and not get their citizens to gamble. Apparently there's a propensity to gamble, and so I think that's prevented play to earn gaming from taking off in Korea at the moment, even though Korea's, I think, the 5th biggest gaming country in the entire world.
Yeah, it's tricky. Gambling's technically not allowed. However, there's massive investment in, so the gaming industry is huge locally, and there's particularly a lot of investment in, just anything to do with these new digital assets, blockchain based, NFT based, and talk about play to earn, although, in a way that will get around gambling restrictions. So definitely a growing space here for sure.
Good insight. Thanks, Martin. One more for you, Mr. Leek. Currency and potential store of value, or potential currency as well. Perhaps one day Bitcoin can be used as a means of exchange and a store of value.
Do you mind if I just pause you there, Mr. Nash? First of all, I think that your list of use cases for crypto is, until the last one, was ignoring like what it was designed for and what it actually, what the purpose of Bitcoin. I'm going to say Bitcoin for the purpose of this conversation. I've tried to say crypto all the way through the calls, but I'm going to go to Bitcoin this time. But it's designed as a way of fighting back against crony capitalism and a broken monetary system where centralized governments are incentivized to keep inflation at a certain rate to inflate away large amounts of debt that they've accumulated over many, many years of a fiat monetary system where nothing is behind money. So Bitcoin is designed as a way of fighting back against that. It enables like banking the unbanked and uplifting communities around the world that don't have access to currencies that are stable and that aren't manipulated by foreign governments. You know, large amounts of the world are still unbanked, and Bitcoin is all inclusive. Anybody can, with a smartphone and an internet connection, which, would you believe, is actually easier to get than a bank account for many people. Like, Bitcoin allows those people to start saving in a currency, and it is a currency, in a currency where the monetary supply policy is fixed. And that's an amazingly powerful thing. So, like, while all those other use cases for crypto are, I'm not going to say they're incorrect, like that's kind of, to use Paul's word, that's missing the elephant in the room, right? Like, Bitcoin is designed for something quite special, and that's something that's we in the West and in quite established jurisdictions take for granted, that a large amount of the world does not have. And, you know, you can send Bitcoin instantaneously, relatively instantaneously, at relatively low fees anywhere in the world, whenever you want. If you tried to send money to me in the UK from Australia or from Singapore, like, you would be going through at least 3 trusted third parties that would all take a cut, and it would take a number of business days to settle. Extremely inefficient. Bitcoin would be instantaneous. I've done it sending money to, you know, family members, friends through the Lightning Network, and it is working as a payment currency. So, you know, I do think it's worth stressing that it is more than just trading, gambling, and gaming.
Thanks, Mike. I think technically it's not considered a currency, but I get what you mean.
Who decides what is classified as a currency? Sorry.
Well, I think the part that Bitcoin is missing is it's got to be stable, and then it's also got to be able to be exchanged for goods and services. And at the moment, I think it's limited on that front, on both fronts. It's definitely not stable.
More stable than the Argentinian peso. Is that a currency? Sorry, I'm not trying to be difficult, but like, where do you draw the line?
It is a gray. There is a very gray line, right? When you start looking at, if you think about Aussie dollars, you think, well, that's a nice stable currency. But Mike's got a good point, right? You can.
Look, he has a
government issued currencies that are less stable or less trusted. So
could you use it for your daily transactions where you are at the moment in this point in time, without jumping on a plane to El Salvador?
Actually, you can. I have a family member that's the only thing he struggles to buy with Bitcoin at the moment is fuel for his car. But everything else you can do through Bitcoin in the UK.
Fantastic.
There's an airline that just accepted. I can't remember which airline it is. They just started accepting as well. Just because you used the example of flights.
Let's explore what potentially makes crypto different to TradFI. We've laboured this point here: lack of regulatory engagement and enforcement, non-banks pretending to be banks. So, you know, people like Celsius acting like they are a bank, but then you don't get the same protections as if you were depositing your funds with a bank. Digital only, yes, TradFI has digital versions of money. I mean, most of the time we're exchanging goods and services, we're using electronic payments. We don't actually use the physical dollars, but in crypto, blockchain, in Bitcoin, it is purely digital only, and where you hold your money is digital as well, just software. So we have wallets to custody our assets, our tokens and our coins, and we use blockchain to settle the transactions. And because we're using blockchain, there's immediate settlement. Mike mentioned it's fast and it's cheap. Okay, what more could you want? It's pseudonymous, hopefully I pronounced that correctly, pseudonymous, which means that we know that somebody is holding something. We know that there is a Bitcoin in a particular wallet, or a public key address, but we don't know who the holder of that is. So they haven't revealed their identity. Chains are governed by DAOs mostly, rather than entities, so like a company. So where you are investing in stocks, they're issued by companies or entities, legal entities, whereas blockchains are developed and governed by DAOs, which have their rules contained in their smart contracts. That obviously doesn't apply for Bitcoin. There's no lender of last resort. Markets are 24/7. There's no trading halts. So the market can be extremely brutal, and therefore firms collapse much faster than in the traditional space. Code is law, even though it isn't really, but smart contracts and the immutability of blockchain technology means that once you execute a transaction, let's say even if you're forced to execute it, somebody's got a gun against your head, you know, that transaction has done, you verified it, it's immutable, we can't theoretically erase it from the blockchain. Lack of tailored accounting standards, a greater number of new products at the moment, and terminology.
One big one is around interest rates. Like interest rates in TradFI are set by central banks and then adopted by TradFi players, whereas any yield or interest rate in DeFi space is market driven. And I think that's pretty powerful. So to find a risk-free rate in DeFi, the closest thing you can get to that is by looking at the yield on a liquidity pool involving two stable coins. So like USDC against USDT, sorry, UST doesn't really exist, USDT, and looking at the yield from yield earned by contributors to that LP. And that would be like your risk-free rate.
Do you think these differences prevent crypto from being controlled akin to, you know, the financial instruments that are controlled in banks? Do you think this disqualifies them from the controls race?
From a more, can we meet our own objectives by making sure we've got our own controls in place, then we should be doing that just the same, right? Doesn't matter how.
Yeah, I think so. And to your point about lack of regulatory engagement, I think it just makes the point even more that this is just a different asset class, and that given the risks are so much more severe if you send, you know, a transaction error, and then the markets are open 24/7, they don't halt it, that you really need to make sure you're managing your risks well. That's what it says to me. I see crypto and TradFi the same here. You know, when we're wanting to execute a trade, you know, we have to go to a particular trading venue to do that, for both financial instruments and also crypto. You know, we have to settle that transaction, although crypto is going to be much faster than TradFi. We have to manage the same types of risks, you know, typical ones are market, counterparty, and funding risk. If we are trading on an exchange with an open contract, or where we've leveraged ourselves, we have to monitor and settle margin on both. We have to source a valuation for each as well. We have to know what our position, what our asset or liability is worth. For settled transactions, you know, we have to safeguard custody of assets, whether they're cash or tokens or coins. And we have to prepare financial statements about, you know, how has our performance been? What's our statement of financial positions? What do our cash flows look like? And then potentially in crypto, if you are regulated, you've got to produce reg reports. So that's primary difference here. And then also, I guess there's going to be a difference in compliance with laws, okay? So there's an underdevelopment of laws with crypto, but then they still have the AML and terrorist financing laws, which they're meant to be complying with. So let's explore some of the things that if you were a trading or lending organization involved with crypto, what are some of the things that you need to consider? And I think the FTX failure highlighted the value that independent boards bring to an organization, and Paul touched upon this earlier. Essentially, if you have an educated and engaged board, they understand the risks facing the firm. And I guess there's going to be a smaller pool of talent available for this when it comes to crypto. But they understand the risks, and they help establish an appropriate risk culture and appetite. Now, management, it's then up to the CEO and the executive committee to implement their business plan. So what's their strategy? What do they want to achieve? And then their risk management strategy as well, to stay within that risk appetite and culture that the board demands. We then talk about, the board wanting to make sure that you're resourced appropriately to achieve that risk management strategy and business plan. And we've already spoken about the chief risk officer heading up the risk function for the organization.
Actually understanding the product, understanding the crypto and those risks is going to be the hardest thing. So
we spoke about control frameworks trying to help us achieve our objectives. And some of the objectives could be, wanting to earn a specific NPAT or return on capital. Obviously, people in finance would want to issue materially correct financial information, and we want to keep the directors out of jail, so complying with the rules and the regulations. Although it only seems like the Russian crypto companies who are based in China get targeted at the moment. Okay, so to achieve these objectives, we want to take, obviously, directional risk in Bitcoin. Could be taking directional risk in Bitcoin to achieve that 150K in the return on capital. And then Paul made a good point that you'd only be pursuing business activities with likely returns greater than 15%. And to comply with these or achieve these two objectives here, what are we going to do? Well, we're going to employ qualified staff and enough staff, and we're going to deploy good systems and controls. This next slide is quite basic, but essentially the reason why I had to put this in is because allegedly FTX had no proper system of internal record. It was the worst John Ray had seen in his career, and I think he's in his 50s, and he's seen some disasters, absolute disasters, including Enron. So we need to have an internal system, record your trading or lending activities. And there needs to be an independent function which confirms that details are accurate. And this is usually done by operations from confirming the trade. Details are important because this is what we're going to use to generate our accounting reports, our tax filings, quantify our risk exposures, determine our funding requirements, and submit our reg reports. So you cannot have a lackluster internal system, and you can't use QuickBooks for a multi-billion-dollar organization. We come to identifying and controlling risks, which Paul alluded to earlier. There's several different categories of risks which we're going to look at, ranging from market all the way to compliance risk. And look, I think that all these risks exist both in crypto and in TradFi. I think perhaps the risk of immutability for accidental transactions is much higher for crypto than for TradFi.
I know you've got their risk of theft of data or assets, but I suppose cyber risk is more significant in the crypto space. I don't know if that's what you're alluding to with that point there.
Well, where would you throw cyber? Would you have a separate external risk major?
IT risk, when it's operational, IT risk is part of operational, like if you want to go into that, but it's obvious. I mean, you could almost have cyber as a risk group, which is not the traditional. I don't think cyber is. I think it's part of operational normally. But if you were doing a risk management framework, you could separate it out because it's so key. About it is digital. So, and if you're going to have your own wallet, then that raises. It's just going to be such a key part of the control framework. Tables are to group risks together, but I would probably say that you would elevate it in.
That makes sense. Yeah. Makes sense. Okay, so let's look. If we're looking at trading desks, the biggest risk that they're taking is market risk. So we spoke about being able to identify risk. We now need to not only identify something but measure it, and then implement a control to make sure that we manage that risk to an acceptable residual level. So in honor of Mr. Leak, we're using Bitcoin as an example. So if we held a Bitcoin trading position, we would need to understand, what our dollar sensitivity, if we are a typical entity reporting in, say, US dollars, we would need to understand what our dollar sensitivity is to changes in the underlying Bitcoin price. Now, for this, we'd need to know what our position is, and then we'd need to have a particular parameter we're measuring it in. So let's assume that we've got a whole position, which we'll call our delta. And then we're looking at Bitcoin, the sensitivity to the Bitcoin price from a $1 change, $1 change in the Bitcoin price. So if we hold 10 BTC and Bitcoin changes by $1, the impact on our profit and loss on our balance sheet is $10. If we held 10 Bitcoin at the money call options, we'll have to appreciate that the delta profile for a non-linear instrument like options is different from a long holding in BTC. And so the delta profile would be 0.5 times that 10 BTC, which gives us a dollar exposure of $5 every time the Bitcoin price moves by $1. Now, in banking, they generally measure their exposure to interest rates in basis points, so a 1 basis point shift, to Vega or implied volatility, which is measured through Vega by 100 basis points, and then commodities through a $1 change. So now that we know what our exposure is, we then need to determine what our loss tolerance threshold is. And banking organizations at a very high level use what we call value at risk, or VAR. And VAR seems to be on its way out and getting replaced by expected shortfall. But the beauty of VAR is it gives you a dollar number for all the risk that all the traded risk that you're carrying in your organization. So VAR will tell us with a particular confidence level what's the probable losses based upon our current position and say the past 2 years of daily price movements. So let's say that we're looking at the Bitcoin price for movements for the past 2 years, which is about 500 trading days. And if we're using a 99% confidence level, we'll take the 5th worst price drop in Bitcoin if we were long. And I did that today, and it was actually only a drop of 13%. Only, he says. I was expecting much higher. So look, based upon a 13% drop in Bitcoin, we're going to have a VAR of minus $26,000. So what this tells you is, based upon your position, 99% of the time, you're not going to exceed $26,000 in losses. So it could reach as high as that. But 1% of the time, say 2 to 3 trading days a year, the losses due to your market risk position could exceed that 26K. So bear that in mind. The other point to make is that perhaps the digital assets you're trading are not in your native currency. Perhaps you're in a foreign currency. So because of that, when you go and buy that particular asset, you'll have to swap your money from, let's say, Singapore dollars to US dollars. And then you'll have to swap your US dollars for Bitcoin. Now, if you have to go through that, if you're measuring Bitcoin against US dollars, and eventually your money will get converted from Bitcoin into US dollars, the US dollars will then have to be converted back to Singapore dollars, which basically gives you a foreign currency exposure, which you need to manage. So when it comes to credit risk, we've seen a lot of losses in crypto due to credit risk. It's been quite a brutal 2 years. So this is the risk of financial loss due to counterparty not paying you what they owe you. So I think the biggest thing, and Mike's labored the point about self-custody, and rightly so, but the thing about counterparty risk is you need to know when you have it. So I think many of us, including institutions, didn't appreciate the counterparty risk that they have. So an exchange that you have your funds on, a CFI platform that you're lending to, OTC bilateral counterparties, banks, these are all examples of counterparties which you have exposure to if you have funds placed with them. So when you do identify a counterparty exposure or credit exposure, you have to quantify your risk exposure, first of all. And one of the ways to do that is to determine what your exposure is. So it could be your if you're on a CFI platform, your principal plus your interest. You then need to apply that against how likely is it, do you think, that this counterparty is going to default? And if it does default, what is the loss that you're going to incur? So in the CDS market, the standard loss given default is 60%. So you're expected to recover 40% of your funds. So if we were to say, right, we have 100 Bitcoin on deposit with Ledden, which I don't. If anybody's got a $5 wrench out there, I don't have 100 Bitcoin. But if we did, Ledden's quite a reputable provider. And if we looked at if they are trading the CDS market, roughly like a 300 basis point CDS quote would give you about a 5% probability of default. So based upon our exposure of 100 Bitcoin times by the current market price, probability of default of 5% and us losing 60% of our money, essentially our expected credit loss would be about $60,000 for this exposure. And I suppose this is where you ask yourself the question, are you comfortable with that level of exposure? And
that's not your exposure, that's your expected loss given default, right? So you say that credit exposure equals, your credit exposure is 100 Bitcoin multiplied by 20,000. So what's that? 2 million or whatever it is. If there is the credit event, you often have funds locked up for a long period of time that you don't have access to. So you may get a large amount of it back, 40% or whatever it is, but it takes, could take 2 years to get that.
So we could sort of split the exposures across a number of different exchanges or CFI providers, or just self-custody. 3 Arrows Capital collapsed off the back of Terra Luna. And 3 Arrows Capital, I don't think this was the case when they first were exposed to Terra or Luna. I can't remember which one it was. But essentially, their exposure to that organization was the largest on their balance sheet, and it exceeded, I think, 25-30% of its capital, or perhaps even its assets. One of the rules that they have in the European banking community is that you shouldn't have an exposure to an organization or a counterparty which is greater than 25% of your capital. So the benefit of having that rule is that if a counterparty unexpectedly defaults, then you've still got 3/4 of your capital left.
Example of that, Peter, is I believe Ledden you used as the example there. They had exposure to FTX, but it was a manageable size exposure, and they sent out an email to all their customers, and there was no client funds lost. So they're obviously managing their concentration risk in that instance better than a lot of other players.
Yeah, so Pete's touched on market risk and credit risk, and I just want to look at another risk that is fundamentally important to any corporation, which is liquidity and funding risk. And the way I define liquidity risk is your ability or inability to meet your short-term obligations without disrupting your day-to-day operations. And I think that's what's key here, the bit on without disrupting your day-to-day operations. And essentially means, do you have enough liquid assets to cover your immediate liabilities? So I guess what would be helpful here is just provide like a real life example. So I was part of the treasury team of a CFI provider for crypto borrowing and lending. And that was a day-to-day operation, so borrowing and lending cryptocurrencies. But like any other company, we need to have enough cash and in the correct currency to be able to pay those obligations. So things like your salary and wages, your supplier invoicing, leases for equipment, etc. So you just never want to be in a position where you've run out of cash and you can no longer conduct your day-to-day activities. And that's kind of what's happened to some of the players in the space like Celsius and FTX. Once they are under a liquidity squeeze, they have to pause their withdrawals and platform activities. So it kind of just renders their whole service redundant, and you never want to be in that position. So what are some of the controls that we could have to monitor liquidity risk and prevent these scenarios from happening? First one there is have a system in place to monitor your firm's inventory and cash flow ladder. So, you know, it's about having like that single point of reference to be able to look at what are your inventory levels. So if we had, you know, a number of different digital assets sitting in FTX, exchanges, Kraken, you have assets sitting in cold storage in Gemini or hot wallets in Fireblocks. There's so many different places that you would keep these assets, but to manage it properly, you need to make sure that you have a system that can either take data feeds or APIs so you can consolidate it into a single view, and you can make a decision based on that. So what's important here is the data that you have to work with has to be accurate. The data has to be reliable. And as cliche as it is, rubbish in is rubbish out. So it's imperative in most organizations to ensure that your data is clean and accurate. And yeah, so the second point I have there is what are your cash inflows and outflows over a number of different time horizons. So that's in reference to forecasting your future cash movements. And that could be over a week, a month, several months, a year. So that's more of a way to monitor your expected or known flows. And that's pretty easy to do, but there's also elements of unknown and unexpected cash inflows and outflows. And one good example I can think of is when the whole, Terra Luna collapse happened. A lot of these CeFi platforms had money just pulled out of them because no one had, trust in that the custody of the assets was safe anymore. They wanted to self-custodize. And these would be, unexpected and unknown withdrawals of liquidity, and there's no way for you to predict it. But the only thing you could do is model in stress test scenario. So what if 10% of my currencies being pulled out of the platform? What happens if 20% is pulled out? So you just have these number of different stress scenarios that you can forecast out, and you just have scenarios. Okay, at what point do I become inoperable? And so when you're doing these forecasts, you'll find that there are times when you have cash or currency surplus and also shortfalls as well. So the third point is, how will we fund those shortfalls and how will we deploy the excess liquidity? So shortfalls we can fund either through overdraft facilities or revolving credit facilities, or maybe you have a cold storage of assets that you can set aside to draw down on in emergency situations, and just have a venue so you can convert them into the appropriate currency that you are short on. In events of excess liquidity, I guess the whole exercise that you could do there would just be optimize your balance sheet. So are you able to lend out these assets, or is there a way you can purchase a term deposit or a bond where you can generate some kind of yield, but knowing full well that when in the future you need that funding, so you could buy a 3-month, 6-month, 1 year, etc. And lastly, it's you need to be able to monitor and manage your liquidity. And something that we can take from the TradFI world is from Basel III. So after the GFC, there were regulations put in place to make sure that all banks have the correct liquidity and capital requirements. And there's two main ratios that are used to monitor that. That's your liquidity coverage ratio, your LCR. And that's just to ensure that you have enough what's called high quality liquid assets. So could be cash and cash equivalents to be able to pay 30 days worth of net cash outflows. And the second ratio that you should monitor is NSFR, which is your net stable funding ratio. And that's basically anything beyond 1 year, or your assets beyond that have maturity of longer than 1 year. Are you able to fund your required stable funding for longer than a year? So cash and cash equivalents will have 0% weighting because they are completely liquid. But what if you're holding things like corporate bonds or derivatives? So these will have like a much lower weighting to them on how much available stable funding that you could have to support that capital requirement. And
yeah, I think NSFR really made headlines or made its way into banking after the GFC, and there was a UK bank called Northern Rock, which used to issue mortgages, which I guess the average life was probably 3 to 5 years based upon the contractual arrangements. And then they used to fund those using short-dated liabilities from interbank counterparties and deposit holders. And then they took on too much risk, and then there was a run on the bank. So literally mums and dads pulled up the English love a good queue, pulled up their armchairs outside the bank and withdrew all their funds. And then out of time, but we'll make sure we cover the material points. Essentially, and this ties in with the balance sheet reconciliations as well, you can't start accounting for something or financial reporting for something if you haven't entered into a contract. Okay, accounting rules around recognition and derecognition need to be adhered to. From an IFRS perspective, it looks at whether you still maintain the risks and rewards. Say you bought some Bitcoin and then I agreed to lend it out to Mike, but then I agreed to get it back off him in, say, a few days' time. And then I'm going to get charged by Mike a yield for borrowing the money and giving him my Bitcoin. That's known as a secured financing transaction. So we wouldn't actually derecognize it from our balance sheet. But essentially from an accounting perspective, you've got to look at whether you are able to recognize something. And once you have you satisfied a condition to de-recognize something? So IFRS, do we have the risk and rewards, even if we don't have legal title of the asset? And US GAAP is more from a controls perspective. Classification and measurement. So I think we've already discussed that there's a lack of specific accounting rules for crypto and Bitcoin. So at the moment, you can account for crypto either as inventory or intangibles. And for inventory, essentially the default measurement is the lower of cost and net realizable value. But I'm not doing this, but if you're holding Bitcoin to sell in the near term, then you can account for it at fair value. When it comes to intangibles, the default measurement is cost less impairment. But if there's an active market, which there is in Bitcoin, you can use the revaluation method. So understand your classification and measurement for your jurisdiction. Valuation, IFRS 13 or ASC 820 for US GAAP. Understand what fair value is. How do you align to that? So what's your exit price? If you're long, what's somebody going to buy it off you for? If you're short, what's somebody going to, or what are you going to give somebody for them to take the short position off your hands? And finally, balance sheet substantiation. So if you're reporting a balance sheet, make sure you're verifying an item's existence. We spoke about proof of reserves before. Make sure we do actually have those assets, those digital assets. Make sure its value is appropriate and it's classified correctly. The second last thing is around operational risk. I won't go into everything here, but we've talked about independently testing controls to ensure they're effective. New product system and change governance. I think when any organization involved in transition and change, the risk levels just go up significantly. So have governance around that. Banking organizations do. We've all laboured the point, particularly Mike, around self-custody, and Paul has as well. Safeguard your assets, whether they're cash, securities, or tokens or coins. Embed oversight, obviously, of outsourced activities as well. I think the point to note here is that Gemini outsourced their yield product to Genesis. Genesis has now gone bust. So Genesis going bust impacts Gemini because Gemini is now going to face off to their customers and basically explain why they didn't have proper oversight of Genesis in terms of its operations, its governance, risk management, how safe were their customer funds. So just because you outsource an activity doesn't mean you're abdicating responsibility. You still maintain responsibility for that outsourced activity. We've spoken enough, I think, about fraud regarding segregation of duties, people abusing their office. When it comes to nostros and wallets, we want to make sure we segregate the duties. So the person sending the money out of the wallet or the nostro has to be separate from the person who's booked a trade or issued a request to make that payment. Rogue traders are notoriously for working into the early hours of the night and not taking annual leave. So if your organization has traders, make sure you take block leave. And in fact, everyone should be taking block leave. So that's like a minimum continuous period of 2 weeks, okay, where they're not allowed to have access to the organization systems. Number 3 is meant to say monitor the use of dummy or internal counterparties. Rogue traders love using these to conceal their rogue trading activities, and make sure all trading books are plugged into the general ledger, that they can't book trades into books which don't feed the financial reporting and also the risk reporting. And finally, to govern against fraud, make sure you know who you're onboarding and then they do what they say they do. The last thing that I wanted to go through is this, and it's called a risk register, which is was Paul's suggestion that we go through. So well done, Paul. And essentially a risk register is where we warehouse and record all the risks that the organization faces. So here we have 2 examples to go through. One is market risk. So we know that if we're long a Bitcoin position, we have the risk of the market prices moving adversely against us. So from a consequence perspective, we know we're going to incur financial losses if that occurs. How sort of big is that exposure going to be? Well, it's going to be high if it does. The consequence is going to be high if it does happen. How likely is Bitcoin price going to drop? Well, I think unfortunately it is very likely. It's a very volatile asset. And so therefore the overall inherent risk in the activity which we're undertaking is high. Now, the owner of that risk is the trading desk. They're the one managing the position. But then we can reduce down this inherent risk rating if we implement certain controls, like put a total exposure limit from a delta perspective, number of coins, put in a stop loss limit, say of $50,000, after which the desk have to close out that position. Now, the owner of that control will be both the trading desk and the market risk team, to making sure that control is designed correctly and is also performed on a continuous basis. So after we implement that control, we can consider our residual risk rating, which is the $50,000 loss, as low. So it's okay, which is why it's green. Now, we mentioned before that we have to test controls independently. That means a third party within the organization needs to test them. And they test to make sure that they're being designed correctly. And designing something correctly means that It provides excellent protection against the risk it's meant to be mitigating. From a performance perspective, you want to make sure that it's being consistently performed or always being performed. Unlike the T+14 report at UBS, which wasn't run for periods as long as 10 months, which the rogue trader Cricket Bolly used to engage in rogue trading. If we just go down to credit risk to finish off, so credit risk, the consequence of a counterparty like Ledden or Binance, where we have our funds collapsing, would be a high consequence, a red rating. The likelihood of Ledden collapsing, I think, is low, given the fact it's one of the more reputable players in the market. And so therefore, I think the inherent risk rating would be something like an amber, a medium. And again, we establish who the risk owner is. We establish controls like exposure limits, perhaps, or 25% of the assets, so we don't exceed the large exposure limit. That should be capital rather, not assets. And then we've listed out that the XVA desk owns the credit risk along with, this should be credit risk, not market risk. I'll update that here. Okay. And this should be capital.
I would say that the likelihood rating there is just an example, and that we're not implying that we've done a complete deep dive into Ledden's credit risk.
Good point. And I think Paul also wanted to make a note, as I do, that this is not a panacea. We're not presenting all the risks and the controls you need to implement. This is just a sample for you to consider.
So this is just good practice. It's a tool to basically show that you've assessed all the risks, you're monitoring them. So obviously the likelihoods and the consequences might change. So in theory, you might end up, one of the controls you might end up having on the exchange, you might have an annual review to see whether or not the likelihood ratings change. It's a way of sort of deciding, sort of making it clear what the controls are, who the owners are. It's ascribing responsibility. It also would feed into things like KPIs to the board.
To summarize, from my perspective at least, is I think cryptos and Bitcoin's lack of regulation just places greater reliance on management and the board to manage risk well. So control frameworks obviously involve a cost, an investment, but it's obviously cheaper than the alternative. And we've seen what happens in banking when the investment is not made. And finally, appreciate what the risk appetite is for your organization and identify your material risks, design controls, and independently test those within the firm's risk appetites. Run a risk register. It's good market practice. And from a behavioral point of view, make sure the officers in the company hold themselves accountable, that they're transparent, and then also that the firm is properly resourced.